Welcome to the video. Today I'm going to discuss what are the sequence of return risk. So sequence of return risk refers to how important the timing of your investment performance is when you are in retirement and beginning to take withdrawals from your savings and investments. So for most people, as you're saving for retirement, whether in a 401k or a traditional IRA or Roth IRA, you're not taking withdrawals as you're approaching retirement. You're just allowing your money to be invested however it is, and it's going to go up and down based on the performance of the underlying assets. But you're not taking withdrawals, so the short-term price movements don't matter as much. So really what's important with your returns from those different assets in your retirement accounts is what are the average returns over a very long period of time. That's really the most important thing. But as you are approaching and beginning your retirement, the timing of those returns becomes critical to how long your money will last. So when you begin taking withdrawals from a retirement portfolio, the market performance earlier on in your retirement becomes paramount. If you have bad or down years in the market early in your retirement, when you begin taking those withdrawals, it has a significant impact on how long your money will last. So we all know that over the long term, the S&P 500 and the stock market has performed well over long periods of time, but we know less and less what's going to happen in markets over a short period of time. So addressing that short-term risk in markets is really important in retirement when you're planning to take distributions. So how can that risk be addressed? And again, we're just talking about the timing of your investment performance early in your retirement. How can that be addressed? One way is just keep enough cash on hand where you're not going to have to be forced to take withdrawals from your investment portfolio in a down market. That's one way that it can be addressed. Another way that it can be addressed, and obviously I help with these products, is with annuities. Annuities can address this sequence of return risk in a few different ways. One, you can purchase an annuity that provides guaranteed lifetime income, and that income is not going to fluctuate at all depending on any type of performance of the stock market or some underlying index. That income is going to be guaranteed. It's fixed in the contract. You know exactly how much it's going to be. And when you have guaranteed income like that, the timing of your investment, if you're not planning on taking distributions from those investments, the timing isn't as important. So you can essentially buy yourself a longer time horizon for your other investments. You're not going to be forced to take those distributions when the market is down. Another type of annuity that can address sequence of return risks is fixed annuities with either a fixed rate or with a zero floor, where you know that when you take those distributions, your account is not going to be negative due to market losses. So with fixed rate annuities, you're purchasing an annuity for a set number of years. The rate is fixed, it's locked into the contract. Currently, those rates are still very attractive. They're pretty dependent upon interest rates, but right now they're still attractive. And so your interest is going to be fixed, it's locked in, you know exactly what it's going to be, and you can plan those withdrawals from those annuities to address sequence of returns risks. Index annuities are another option where there's a zero floor. You're able to get potentially more upside than you can get in a fixed rate annuity, but it's not guaranteed. It will depend on the performance of an underlying index like the S&P 500. But you're not going to get all of the performance in the S&P 500. So the simplified explanation of that type of index annuity is you're going to get some of the upside of the performance of the underlying index, but if the index goes backwards year over year, you're not going to take any of the losses. That can also address the sequence of returns in that zero floor protects you against market loss. So you're giving up a little bit of upside for all the protection of the downside. Again, there are different ways to address sequence of return risk, but it is important that you understand when you retire and when you start to take withdrawals from your retirement accounts, from your investments, it's important that you understand that the timing of those investment gains or losses earlier in retirement is going to have a major impact on the long-term performance or the longevity of that underlying portfolio. If you have any questions about sequence of returns risks, if any of this doesn't make sense to you, if you want more information, feel free to reach out. I'd be happy to help.